and welcome to the Stockout. Mike Baudendistel here from FreightWaves. I'm an analyst and market expert and head of intermodal solutions at FreightWaves. And today on the Stockout is I'm going to be talking about the retail route last week and what that means for a CPG company. So I'm not going to be talking a lot about CPG companies themselves, but to follow any industry, I think you want to look at their suppliers and their customers. And I think a lot is to be learned from what the CPG, retail partners said, last week. Shares were declining, heavily for Target and Walmart last week. So I'm going to talk about those things, and from there I'll talk about what's happening on the supplier side with palm oil in Indonesia, and then give you some overview of what's happening in the data that we collect at FreightWaves and the FreightWaves Sonar product. But first, we'd like to thank our sponsor today. Our sponsor is Axle Logistics. There's the Axle logo there, ranked 39th on Transport Topics list of top brokerage firms. Axle Logistics takes a consultative and streamlined approach to your CPG shipping needs. Email sales@axlelogistics.com to connect with the team today. We're also going to have someone on from Axle Logistics on a future episode of the Stockout. I think it's going to take place 2 weeks from today, off next week for Memorial Day. But the following Monday, we'll have someone on from Axle Logistics. So big thanks to Axle. So with that, I'll talk a little bit about what happened last week for those that weren't plugged into the news cycle with retail. So really the topic number one is this retail route. Really the stocks of the retail companies took a pounding last week. You look at Target's shares are down about 30% for the week last year. You see Target's, if you can see the screen, Target is in black. You see that down in the last that's a 6-month chart, down 38% in the last 6 months. About 30% of that decline came in the past week. You see in yellow, that's Walmart. Now Walmart's down about 15% in the last 6 months, and all of that decline and more was just in the past week, down about 20%. You see in blue the S&P 500 in the past 6 months, down about 15%. And basically what happened is both those companies reported earnings last week. A disappointing outlook. Target, some of the highlights here or lowlights is Target had a 48% EPS decline despite a 3.4% increase in comparable store sales. So not a terrible same store sales. But what stood out was Target's operating margin basically cut in half to 5.3% from over 10% a year ago. Walmart had been expecting a mid-single digit EPS increase for the year, and now they're expecting a decrease of 1%. So some pretty significant cuts to outlook there. Walmart is now actually increased their expectation for sales, going from 3% this year to 4% this year. That could have just been due to higher price levels with inflation, maybe more than offsetting a decline in volume. And then the gross profit pressure that Walmart saw was 3/4 related to higher supply chain costs, including fuel and e-commerce fulfillment. So it was really transportation and logistics driven. And for those that were talking heads that said last week that how could the biggest retailers in the world not have anticipated that? Well, I think basically the retail truck stop price per gallon is maybe one illustration of that. They're not buying on price on retail, but you can see the retail price of diesel fuel now at $5.60 per gallon, and I don't think anyone fully anticipated that those costs rising as much as they did. There were also other costs that the retailers had that were somewhat unexpected, and the labor costs that the retailers had, either they had too few people or too many people. Even with COVID waning, too many people, Walmart talked about, came back all at the same time. They didn't want to get rid of people because it is hard to hire, so they just sort of let the headcount decline due to attrition, but that caused elevated labor costs. And so you saw all of those things take a big bite out of the profit margins. Walmart said their diesel cost was an extra $160 million, in the quarter. And it just takes time, I think, for a lot of the big retailers, a lot of big companies, when they see a big spike in their costs, to fully get those costs back in the form of higher prices or greater efficiencies or any of those things. So in addition to higher costs that the retailers had, the other thing that took place was really there was a big mix change in what was sold. So there was a lot more grocery and less what Walmart calls general merchandise, which is basically anything that's not food or consumable, sort of anything that's not CPG, essentially. And so inventories now at the end of the quarter were really heavy for Walmart and Target, up 33% and 43% respectively, higher than they were in the year ago period. And it's important to draw this distinction between the general merchandise inventories, which are way higher than they were a year ago and really at an elevated level, versus the food and consumable inventories, which are still low. And that's related to Walmart's comments that it's likely to do discounting for a lot of the general merchandise type products, what they call rollbacks. You're going to see a lot of those. But on the food products, they still think there's going to be further inflation to come on food and consumable products. So it's really, I think, not great news for consumers, even if there are some lower prices on certain products, because really the products that people need are, going to be the ones that are going to have higher, prices. So that's just a little bit of a snapshot of what took place, last week in the world of retail. And so going on to, topic number 2 is really, what do those retail results mean for the CPG industry? And I would argue that it's mostly negative, but based on my count, I have 2 positives and 3 negatives when I think about sort of what that means for the CPG industry. First, on the positive side, think that the results from Walmart and Target show that consumers are still spending a lot of their paychecks at these big box retailers. They're spending just as much or more than they did a year ago, with same-store sales up. That's not true of a lot of retailers, particularly the retailers that are more focused on the selling discretionary items. You see the same-store sales forecast for companies like Best Buy, Bed Bath & Beyond. Those are going to be negative. Walmart and Target still showing those as being positive. So it still shows that the consumer is at least not cutting back on spending overall. The other thing that those results show is that CPG items are clearly not the first thing that consumers cut back on. Neither of those companies was talking about consumers really cutting back on CPG, maybe with the exception of some trading down from national brands to private labels. But the big decline at Target is what they call hard lines, which is basically anything other than consumables or clothing. So that would be things like furniture, appliances, electronics. Those are things that are big ticket items. Consumers have a pretty easier time cutting back on those than telling their kids that they can no longer have Lucky Charms. So that's, I think, what we're seeing. With Walmart, you're seeing a lot of higher inventories, not just from consumers cutting back, but I think really from a lot of the pull forward associated with the retailers getting goods into the United States quickly, to avoid a lot of the congestion that's taking place, at or near the ports, all of the container ship lines, stacked up, all of those things. So those, I think, were 2 positives for CPG. Maybe on a relative basis, CPG is holding up relatively well, which is one thing that tends to be why CPG or consumer staple stocks tend to perform relatively well in a down market. They've outperformed, this year and tend to be good freight for carriers to haul. They do tend to be pretty consistent. But there were some, negative takeaways from the retail earnings last week. And I think the biggest one is Walmart. When you hear Walmart saying that they don't see any evidence of inflation subsiding in food, that's a concern. I agree. I don't see, evidence of that subsiding either. And in fact, I think there's going to be further shoes to drop as the impact is from the Ukraine situation with, grain and, ingredients and food and energy prices. Energy goes into a lot of packaging and fertilizer. All those things get sort of fully worked through food prices. I don't think those items are fully reflected in food prices yet. It takes a while for those impacts to fully be felt. Given how long it takes for crops to be grown, harvested, distributed. So food prices likely go higher. So that's bad news for consumers overall. And then another negative is Walmart. Another negative for the national CPG brands, at least, is Walmart is seeing consumers trade down from the national brands to private label, food products. That's something that could hurt the major CPG companies. During the pandemic, one of the big trends in CPG is as consumers had more disposable income to spend, with spending less money on gas if they were staying at home, or with all of the government stimulus checks, they opted for the national brands for one reason or another. Maybe it made them feel better. Maybe they felt more comfortable spending a little bit more on some of these items. But that's something that the CPG companies are vulnerable to. Something that Treehouse Foods, which is a company that makes a lot of the private label food brands for companies like Trader Joe's, has talked about, and they've actually have some interesting stats on how the states that took away some of those stimulus checks sooner, they saw an uptick in the private label in those states sooner than they did in other states that kept those stimulus checks flowing a little bit longer. So that's something that's not great for the CPG brands. And then also I think you're going to see a shift in groceries to Walmart and some of the big box companies from traditional grocers. And I think you started to see signs of that in the results that reported last week, where Walmart was taking share. It seemed like they were taking share in groceries because the sales there were pretty strong, and it's an easy way for consumers to cut back on grocery prices, is go to the company that has the best prices there. And I thought some of the comments from Walmart were pretty telling too. That Walmart basically recommitted to being the price leader in a lot of those items, where it seems like they're willing to sacrifice some near-term margin in order to maintain the reputation, and not even just the reputation, but actually have lower food prices than their competitors. So you wonder if Walmart doesn't come out of the this inflationary period maybe in a better position than some of the traditional grocers, because sort of go Walmart for lower prices, you realize that their grocery offerings are better than you thought they were, and that behavior sort of sticks. I think that's a negative for a lot of CPG companies because I don't think anyone negotiates harder than Walmart, given their size in the marketplace and just their negotiating clout. So that could be a negative for CPG companies' margins. So on balance, I think that last week's retail earnings paint a picture that this year is going to be another challenging year for CPG companies, at least on their margins. You think back, last year, 2021 was a year where CPG companies in general, really faced a lot of margin pressure, where their input costs rose faster than they could pass those costs on, through the retail channel and onto consumers. I think a lot started the year 2022 hoping that this would be a year where they could, those margins would rebound, where they could, pass those higher prices onto consumers. But still, I think what the retail results show is there's still going to be remaining, margin pressure this year, either from, a combination of higher, input, costs, or just, maybe dealing a little bit more with Walmart and some of the big box retailers. Topic number 3 here is really an update on the next, development in a topic that I've followed on the Stockout, which is Indonesia lifts palm oil export ban, which is good news for CPG. So this is an image of palm oil, being collected in palm fruit, being collected in Indonesia. And palm oil goes into a wide range of CPG products. It can be anything from food that competes with other vegetable oils to various personal care products. About 85% of it comes from either Indonesia or Malaysia. About 60% just comes from Indonesia. And What they did was they became more protectionist in order to keep food prices down for the domestic to Indonesia. They're trying to get out of that just because Indonesia produces more palm oil than they need for the domestic market, and so essentially the exporters, once they meet their domestic market obligation, are going to be issued a permit that's good for 6 months to begin exports. And once they do that, it should help help keep prices down globally. Not clear what those domestic market obligation is or when that actually will help with exports. But you do see I have a chart from a bar chart on crude palm oil prices, and you do see that they've cracked a little bit, how they're off of their highs, still way above where they were, let's say, way back in November and December, but still come down. They've come down about, let's call it 15%, from their high on the expectation that these export restrictions, from Indonesia, the biggest supplier of palm oil, is going to loosen up. So that's, the farmers are happy about that in Indonesia. I think the CPG companies would welcome that as well. Topic number 4 here, I'll give a little bit of an overview of what's taking place in Sonar. So contractual shippers still feeling freight cost pressure. Have a chart here that shows van contract rates, and so the blue line is 2022 rates. These exclude fuel. So you see here the average van contract rate, according to a company that processes transactions, $2.91 for contract rates for dry van. Those exclude fuel. You can see a year ago at this time, it was about $2.50 a mile. So it's up about 40 cents a mile. Of course, once you layer on fuel, that's going to increase it another 15, 20 cents, maybe more, with the fuel prices surging. So shippers are still feeling the pressure there, at least those that compete and participate in the contractual market, which is most of the companies that are targeted in this podcast, whether it's the retail companies that want to pay attention to what's happening in the CPG industry or the CPG companies themselves. They need lots of capacity, so they tend to participate in the contractual market. And it does show that for all the talk about a truckload bloodbath and the sort of rumblings here that we've talked about even just today on FreightWaves.com. There's an article that Mark Solomon put out, talking about how the expectation from some of these big shippers is that they're going to renegotiate their contract rates more aggressively, at a faster clip, where maybe they're going to do weekly or even or quarterly type bid packages instead of having the annual contracts that are more typical. We are expecting shippers to get more aggressive, but right now it's still a big headwind on their financials, and so the big shippers are seeing a lot of impact from higher freight costs. That includes these companies I've been talking about with the retailers, big CPG companies. What's interesting also is taking a look at the van contracts versus the spot rates, which I have on this next chart. You see the spot rates in orange. These are spot rates that exclude fuel, and you see how much they have fallen this year. Started the year at about $3. This is the orange line. Spot rates excluding fuel about $3. Now they're $2.08. It's interesting that they have sort of found a bottom there. After going to $2 to $2.08, I would attribute that to maybe just a little bit of tightening right before Memorial Day. Right before Memorial Day, you see the movement of a lot of outdoor products, a lot of beverages, building materials are moving. So it's really a time that's typically seasonally tight in a truckload industry. But it also shows how much lower spot rates are. If you think $2.08 a mile versus $2.91. If I'm a big shipper paying $2.91, I don't know how much longer I'm going to accept paying more than the market clearing price in the spot market before I get more aggressive on, renegotiating, contracts. Freight contracts don't have a lot of teeth. That works, both ways. So I do think the shippers are going to get more aggressive there, going forward. So I think we'll take an eye on keep an eye on that. Would encourage you, if you're a shipper, to benchmark your rates not only against those national indexes, but in Sonar we can break that down by lane and even by shipper type, and so you show you what a CPG company or a retailer or let's say an automotive company is paying versus other companies in that shipper category. And from there, you can determine if you're paying too much, too little in in a particular lane. So there's really the sort of the basic things I wanted to go over today. Would also encourage people, in addition to signing up for my newsletter, which you can do at www.freightwaves.com/the stockout. The easiest way to do that is maybe to go to freightwaves.com, go up to newsletters. And then the stockout is right there at the top. What that graphic doesn't show is that you can also sign up for newsletters like What the Truck. We have a new one on the net zero carbon. We have one in there, check call on the 3PL industry, which is one that Mary does. I think it's really well done. And then we rolled out a new one called Running on Ice, which there's a lot of overlap there with people that are interested in cold chain and people that are interested in CPG. Think about CPG is including a lot of food type products, a lot of products that need to be refrigerated. Even things like cosmetics, do tend to be refrigerated. So if anyone needs to reach out to me, feel free to do so anytime at mbaudendistel@freightwaves.com. And that's really what I wanted to go over today. Hope everyone has a great Monday.